Good afternoon, everybody. It's it's September 24th. It's 1:30, and we're joined, as we are every Monday, by Adam Collins of Movement Capital. Adam joins us each Monday, taking us through the most recent COT report, market seasonality, and a lot of interesting trends and charts that he has spotted. Adam also runs three websites in addition to Movement Capital. He has freecotdata.com, Movement Capital, and simplestockmodels.com, and commodityseasonality.com. It's got a lot of different websites, a lot of great information. Adam, welcome.
Happy to be here. So right off the bat, none of this is investment advice. So, for those listening, don't treat it as such. But for any new listeners, here's what I cover. The first thing is COT data. And COT data is looking at how people are positioned in the futures markets. And this is what sort of a basic COT report looks like. You got different categories, and then within those categories, you got longs and shorts. But the issue is, just looking at this in isolation, like, money managers long X and short X, doesn't give it any context. And so all I do is create a 5-year percentile that just looks at the current net positioning relative to the past 5 years and, scales it from 0, which would be, more net short than they had ever been over the past 5 years, to 100%, meaning that's like the most bullish positioning of the past 5 years. And so the way the site is oriented is you've got all these different contracts with their corresponding graphs. But to discuss what's probably most relevant this week is, let me turn to the dashboard page. So this just aggregates all the 5-year percentiles for each contract. It's honestly more the same with some changes, but basically this is looking at how speculators are positioned in commodity futures. So over here, if it was like, a 5-year percentile, like 100%, would mean that they're super long. Over here, either they don't have a lot of long exposure or they're actually net short. And so precious metals are dominating the right-hand side of the chart. But the difference is a couple weeks ago, it was uniformly precious metals, as in all four: silver, gold, platinum, palladium. They were all quite sort of like consensus short trades. It's sort of changed over the past few weeks in that palladium has been the only precious metal to hold a bid. And so positioning is quite mixed there. It sort of went from a consensus short to less so. And then positioning in platinum also bounced a pretty good bit. So what that translates to is gold and silver are sort of the two last precious metals where spec positioning is uniformly bearish. And then probably the most crowded commodity spec short is actually coffee. And this will help to illustrate, I think, the most important point about COT data is, okay, so if you hear that speculators are super net short coffee futures, the average retail trader responds to that by instinctively fading it because they hear that everybody's on one side of the boat, but they want to be a contrarian, right? So let's look at a chart of coffee futures. So with this, if you put yourself in the mind of somebody who's short coffee right now, are they in pain? No, it's a steady downtrend that's gone their way for a year now. And so with COT data and any sort of positioning data, think of it like this. Crowded positioning is most relevant when price action hurts the most people. And so if you have a situation of where there is truly extreme crowded positioning, like there is in coffee and honestly in gold and silver, that's one thing. And honestly, it's not that common because it happens. But what is uncommon and I think more actionable is when you have crowded positioning plus price action that gives people a huge incentive to cover their crowded positioning. So for example, if silver gapped up 8% tomorrow, you would have a lot of specs called short being forced to liquidate. And so that's when you sort of get like a fire in the theater type move of like everybody runs for the exits at the same time. So with coffee, I definitely wouldn't suggest shorting solely based off of current positioning, but keep current positioning on your radar. And if coffee starts to at least pause its downtrend or actually catch a bid and go up 5-10%, then current positioning gets quite relevant. Let's look at some other contracts. So let's see, we got platinum changed, and then we can look at currencies. So currencies have gotten interesting in that Kiwi dollar is by far the most crowded spec short against the USD, and we can sort of zoom into
Been a bit of a bounce in that, but I guess actually probably happened after Tuesday.
True. Yeah. And so, yeah, that's been the name of the game in the Kiwi dollar. Specs have been really short for a month or two now. And then it's sort of changed in the Swiss franc. So a couple of weeks ago, it was those two together. It was Swiss franc, Kiwi dollar, neck and neck, both credit spec shorts. The difference is that in the franc, you caught a bid. And so that is, a potential resolution to Kiwi dollar, but who knows? So then turning to positioning in equity index futures, it's nuts how, I think I talked about it last week, about how, so this is looking at positioning in E-mini NASDAQ futures. And speculators have not embraced the NASDAQ rally. They're not crowded short by any means, but basically, if you were to tell somebody that the NASDAQ 2 years ago would do what it has done, I would have massively sort of like projected spec long positioning being very crowded to the long side. And so that's quite confusing, but at the same time, these futures it's not that they're thinly traded, but it's just a much smaller market relative to like, cash, tech equities. Nikkei is a very long trade. So speculators have fully embraced long Japanese stocks. We've got probably the most important contract when you're looking at dollars traded. We got the E-mini S&P, and we're off the January highs. So specs were mega bullish, both January and then sort of, they bought the dip, got very bullish. But ever since May or so, it's sort of this interesting setup of, stocks have gone to all-time highs. Spec long position is sort of like retraced, which is not what I would expect. And then we got some VIX stuff. I'll get into the VIX stuff in a second. And so overall, with positioning, you've got coffee and sugar and silver and gold are really sort of consensus spec shorts. No real longs, as in there aren't a lot of contracts where commodity or specs are very bullish. In financial futures, it's dominated by spec short and Kiwi dollar. And what's new in that is both the pound and Aussie dollar speculators have significantly increased their short positions in those two currencies over the past couple weeks. So first let's see, I'll load up, we got some images, cause sometimes I like to look at the actual dollar position. And so this is looking at net spec position in VIX futures. So traders are net short like $1 billion worth of VIX futures and options, which is actually more than they were net short going into early February. And then this is OI in VIX futures. So it's, massively reset after Feb. It's crawling higher now. This is a zoom in on silver. So specs it's a 12-year extreme in spec position in silver. So I think they're net short like $1 billion or so. We got sugar, OJ, Nikkei. This is another way to look at, long spec position in Japanese stocks. We got nat gas, which is nothing to write home about. More often than not, positioning is a complete wash for a lot of these contracts. And I would judge nat gas to be like that right now. So I wouldn't read anything. Hey, can you hear me?
Yeah, I'm sorry about that.
Yeah. So we got copper. So copper's been sort of interesting in that 2018 has been a year of extremes. A couple months ago, specs were net long 5 billion of copper futures at the exact wrong time. And then, copper fell back 20 some odd %. And now specs have dipped their toes slightly net short. I mean, and while if you look at the context of this, it's sort of in the middle of its historical range, but I think it's important to note just how rapid of a change that was. And so copper went from a consensus net long to not in a very short amount of time. So this is like a composite graph. We got WTI and gold. So traders are net long like 42 billion of WTI futures, and they're net short gold. And this sort of setup of like, extreme bullishness WTI, not the case gold. That's honestly quite rare. And the delta between the two, the difference hasn't been that big in 9 years. So we got that. This is a zoom in of spec position in gold and dollars. Let's see what else we got. This is looking at in the E-mini S&P, actually in the S&P, NASDAQ, Dow, all the mini contracts. Traders are in aggregate net long like 75 billion, which is less than a couple months ago, but still quite net long. What else we got? We got WTI. So this chart shows the net spec position as a percentage of the open interest in WTI as it goes from lower left, upper right. What that present in English is that. I mean, WTI, it's becoming more of a financial commodity in that it's more so dominated by the flows of specs as opposed to producers and users. What else? Oh, so this is another good way to show just how extreme positioning is in Kiwi dollar. So traders are short like 70% of the open interest, which is quite close to their positioning, both in 2015 and I think last year. So both those times were like inflection points for that currency cross. And then we got euro, CAD, pound, which were, like I said, traders have gotten more net short, and same so in Aussie dollar. So Aussie dollar is definitely a consensus spec short. And if you want to put that trade on because you think, China's going to continue to implode, you should be aware that everybody else is in that trade. All right, so quickly turning to the other site. So this is looking at seasonality. So it's like the typical seasonal trends of different commodity contracts. The most important graph is this one. And let's look ahead to October. So this is looking at the average monthly performance for different contracts over the past 20 years. So in October, historically, the top performing contracts have been orange juice, oats, soybeans, corn, soybean meal. So honestly, a lot of agricultural commodities have been strong in October. If we're looking at the weaker performers, we're looking at the energy complex. We're looking at heating oil, RBOB, nat gas, and crude right here too. This is looking at term structure in commodities, and term structure matters because think of it, I wouldn't so much say cost of carry, but basically if you want to get long front month, and there's a lot of contango, that's going to be a headwind and sort of detract from your returns. And so right now, honestly, a lot of curves are sort of flat, but where that's not the case is in corn, coffee, and wheat. That's where contango is quite steep. And that is where if you have sort of a reason to be long, just be aware of sort of the cost of rolling that position because it's pretty significant. This is looking at momentum. So this is looking at 12-month momentum in a lot of contracts. Over the past 12 months, the best performers have been crude, heating oil, and ES. The worst performers have been rice, sugar, and coffee. So we can zoom into a couple seasonality charts. So we got 30-year treasury bond right here. Rest of the year, not too much. October's been actually the weakest month of the year in the 30-year treasury bond. And so if you're a bond bull, October seasonality is not in your favor. Also, momentum's not in your favor. So 12-month momentum, why I look at it is because it's a proxy for like long-term CTA sentiment. And when 12-month momentum is negative, meaning the long-term trend is down, a lot of CTAs are going to be biased to the short side in the long-end bonds.
So wait a second, just to go back on that bonds, you're saying that typically the 20-year average is actually for September for bond prices to be higher and then October for them to be lower.
Correct. So like September is typically the tail end of like that historically positive, end of summer seasonality for like risk off assets, which did not materialize this year at all.
Right.
And so, so October seasonality is quite negative for the 30-year.
It's actually pretty interesting also looking at that. The range is very, very small on all months except for August. It's all plus or minus about 0.75%. Except for August, which is almost 3%.
Yeah, it's a function of one, when you're taking like averages of like 20 different periods, it's going to smooth out a lot. And that August, if I remember correctly, that August number is heavily influenced by performance in August 2008. So it was like this monster number that sort of skewed it up. So Euro seasonality, honestly, currencies don't exhibit a lot of seasonality. So except for like, so you look at this line of like yen seasonality. So the orange is like 5-year seasonality. The reason why that number's so skewed in Q4 is because whenever it was a couple of years ago, when the Japanese central bank it went full throttle on easing, yen got murdered in the winter of that year. So that's sort of influencing that 5-year seasonality number. We got S&P seasonality. So we are trading right in line with typical 5-year seasonality for this time of year, which is, as we've been in a bull market, it is quite positive. But if we're looking at S&P seasonals, the last 3 months of the year are historically very strong, very strong. So turning to some other stuff for seasonality, we got copper, not too much. October is typically pretty weak in copper. We got gold, nothing to write home about. October has been a little weak, but these aren't they aren't as sort of strong seasonality wise as Q1. Jan and Feb have been very strong in all of these metals contracts. So we got palladium, which like this graph shows, palladium is basically flat year to date, which is, very different than the other precious metals. Then we got platinum, nothing much seasonal happening. Sort of interesting that platinum's curve is flattened out a little bit. We got silver, not too much. And then I can zoom in on some energies. So energies, I talked about it a couple weeks ago, but heating oil, WTI, Q4, typically weak. And it's important to note that all of the seasonality data, it's for front month contracts. And so it's roll adjusted. So it's assuming that you're owning the front month and you're always keeping the front month. So yeah, Q4 has historically been negative in energies. Turning to the last site, which is sort of S&P centric, what it does is just aggregate together a bunch of S&P indicators, and it's got different pages: technical, sentiment, rates, macro. So S&P technicals are strong. The trend is up. We've got, seasonality turns very positive November 1. We've got, with the FOMC on Wednesday, we're still in the historically positive, FOMC drift period, which is the 20 trading days before an FOMC announcement. It's very strange, but that period has matched buy and hold by being in the market only 80% of the time. We got buyback blackout, which this has changed. So, companies, they don't necessarily have to suspend share purchases in the 5 weeks pre-earnings, but some do. And so what this indicator shows is that
Adam, you there? Adam mentioned before the call that his internet was having some issues.
Looks at the 5 weeks when a majority of S&P companies before they were. And so we just.
Hey, Adam, just you're breaking up a little bit.
Hang on.
Adam, you're breaking up a little bit. I don't know if you know.
Hey, what about now?
You sound fine now, but now the video's gone down.
Oh, do I need to share my screen?
You don't have to, but it was now. Now I see your screen. Yep, you're back with the buyback blackout.
Oh man. Hang on. It's okay. What about now?
Yes, buyback blackout.
Perfect. All right. So wrapping up. Anyways, that's something to be cognizant of in 2018, of where buybacks have been, a big force this year, and we're sort of in the last big blackout period for this year, and so that means that you'll have less companies buying back stock.
So on those three lines, what is that saying? Typically, when there's the most buybacks, it's the white line. Sorry, everybody. We seem to have lost Adam again. Adam, you there? We were going great with technology until about 2 or 3 minutes ago, and he said that early on that he was having some technology issues earlier in the day, so I apologize for that. Let's give Adam another minute or two.
Hang on. All right.
Technology has failed us in the last 5 minutes. It was going so great before.
Yeah, it's a shame. Can you see my screen?
Yeah, we're back.
Okay. All right. So we laugh.
So yeah, I was asking before, if you could break down what exactly is the white versus the blue versus the gold line saying here regarding buybacks.
Perfect. Okay. So the white line is buy and hold S&P since 1993. The blue line is only being long the S&P in the periods outside of a blackout period, as in it's sort of only long when a majority of companies are buying back stock. The orange line is only being long in sort of that 5-week period before the majority of companies report earnings. And so the blue line and the white line are long the exact same amounts of time, roughly half the year each. But the blue line, the period of time of being long when buybacks are active, has significantly outperformed when out the other period. And so it's I think that's quite relevant this year as buybacks have been massive. So this is looking at margin debt. I like to look at the year-over-year change in margin debt, and it's actually sort of decelerated, which is, again, this is sort of similar to positioning in that the bull market has been a runaway bull market. And while margin debt has grown, it's grown less than sort of gains in the S&P. And so that's sort of interesting to me. The things to watch out for with margin debt are rapid accelerations, like we saw before the previous two tops, and then also rapid decelerations, meaning that traders are quickly reducing their leverage, and we're sort of neither of those are happening right now. Sentiment wise, it's honestly sort of a wash. So like this is retail sentiment. This is looking at the AAI survey, the difference between the people responding bullish and the people responding bearish. So it's a spread, and the spread's in the middle. So it reflects neither a lot of optimism or a lot of pessimism among retail investors. We got NAME, which is honestly more active investment managers. That's leaning more bullish. We've got a total put call ratio, which is sort of in the middle of its couple year range. So this is looking at the ratio between puts and calls in the CBOE, and it's at a lack of an extreme right now. So I wouldn't really read into that. And the VIX futures curve, contango's been pretty steep over the past couple weeks, and so that's obviously beneficial for vol shorts. Looking at interest rates, so as everybody knows, the Treasury curve has flattened out a ton, but I personally am not super scared of a flattening. What I do care about is if the curve quickly steepens, and that is sort of the last of our concerns at the moment, at least. So this is looking at high yield spreads. U.S. high yield spreads are very tight. They're the difference between the interest rate on high yield bonds and a Treasury of like a comparable maturity is like 3.25%, which is extremely low. But I care more about sort of if that spread is widening out or contracting, and not so much like the absolute level. And in fact, they've been contracting. TED spread, people talked about this earlier this year, but it's done nothing but come down, and it's at, I think, 19 basis points right now. And then finally, macro indicators, they are healthy in the U.S. Industrial production is up year over year. Retail sales are up year over year. The unemployment rate is low and trending lower. I would get worried if this were to trend higher. ISM PMI business health is strong. It's actually at a cycle high. We've got housing prices in the U.S. have been steady, and EPS is up over the past year. And then that is pretty much it. I'll flip through some of these last things, but if you got any questions, I'm happy to answer them.
I got one question coming in, which is a pretty broad one. It basically said, what catches your eye analyzing the data? Anything surprising that basically catches your eye?
Let me think.
And it looks like the one, while you're thinking about that, it looks like the one major takeaway coming up for the final 3 months of the year, and for October, it looks like energy lower typically with equities higher for Q4, basically.
Yeah, I mean, so like in positioning, the takeaways are the consensus position is, short precious metals, and then also long USD and short these foreign currencies. The takeaway with seasonality is Q4 is weak for energies. October is historically weak for the 30-year, and then Q4 is typically strong for risk assets. And then if you're looking at S&P indicators, technicals are strong, sentiment's mixed to slightly bullish, and macro is very strong.
Yeah, no, a lot of interesting things popping up. We'll definitely be on top of a lot of these. We'll see what happens. We got an FOMC meeting on Wednesday, so we'll see how that affects these positions. And we'll talk. Actually, so I guess the FOMC meeting won't reflect in the next report because the report's snapped at the end of Tuesday, and we're getting the FOMC on Wednesday. But we'll still get a lot of information from that. So. All right, Adam Collins, as always, thank you very much. A lot of great information. We really appreciate you taking the time.
Yeah, as always, I enjoy it. And if anybody has any questions, feel free to email me.
Great. Thanks a lot, Adam. Talk to you later.
Okay.